Great. Well, let's get going. Once again, welcome everybody to the Council's Bay Area Impact webinar series. As many of you know, we've been doing these about once a week since the pandemic began to focus information and ideas on the challenges that our economy has been facing here in the Bay Area into the pandemic, but now as we come out of the pandemic and see a revival in the economy. So we all know that the COVID pandemic has caused enormous economic devastation across California, and we're all looking forward to the reopening. This has been announced for June 15th. We know also that everything just doesn't flip back to normal on the 15th, 16th. It's going to take months and maybe even years in some cases for the economy to get back to normal and for all of our companies to really be again on a solid economic track. And if we look at the range of businesses that have been affected, those that have been most severely impacted have been small businesses. Millions have been hard hit. They are the least able among all of our economy, all of our companies to be able to absorb the shocks that came with the shutdown. We know that many have closed and many will never reopen again. And for those who are still operating, many are right on the edge. They're struggling to survive. And fortunately, federal stimulus dollars have helped. There's no doubt about that at all. But in some cases, especially in the first round, they've been slow to reach a lot of those businesses, especially in communities that are historically underserved. So we know that the closure rate for small businesses is much higher in Black and Hispanic and other minority communities than it is in the small business community generally. So there's a real need for capital. And last year, Governor Newsom announced the creation of the California Rebuilding Fund, which is a public-private partnership that's working to provide low-cost loans to small businesses in California. To learn about what's going on in the fund, we have three terrific speakers who have been highly instrumental in its design and in its creation. Dr. Laura Tyson was involved in that process, designing and implementing the fund as co-chair of the Governor's Council of Economic Advisors, and also was a member of the Governor's Task Force on Jobs and Competitiveness. But beyond that, she's also a world-famous economist. She chaired President Clinton's Council of Economic Advisors. She's a distinguished professor at the Haas School of Business at UC Berkeley, and we're really proud to say she's a past chairman of the Bay Area Council Economic Institute. We're honored, Laura. Thank you.
Thank you.
And joining us also is Bulbul Gupta, who's the president and the CEO of the Pacific Community Ventures, which is a nonprofit community development financial institution that's played a leading role in the creation of the California Rebuilding Fund, and is working directly to make loans available to small businesses. And joining will be Beth Bafford, who's the Vice President of Syndications and Strategy at Calvert Impact Capital, which is a nonprofit investment firm that established the financial investment structure for the fund. So welcome to our audience, welcome to all of our speakers, and we'll start with you, Dr. Tyson, to give us the landscape of how the fund was created and what the strategy behind it is.
Thank you very much. Well, it's been a terrific pleasure to be involved in the creation of this fund. I want to emphasize from the beginning that we had strong support from the State Infrastructure Bank. We worked quite closely with Scott Wu, who is the CEO of the State Infrastructure Bank, California. We also did have strong support at the level of the task force. In fact, this idea, I think initially bringing Beth Bafford into this conversation, she had been involved in setting up a very interesting parallel complementary fund idea in New York. Very instrumental in doing that was Janet Yellen, our very own Janet Yellen, who is now very own, I'll say California, now at the Treasury. And I'll note in a minute, the Treasury is doing some very important things in this area. The point of this is to say that we, from the beginning, felt and with evidence that there has been long-term a growing structural gap in our financial markets. And the gap is we don't have ways to fund small businesses, to provide lending capacity and access to loans to small businesses, particularly those in low-income communities, in disadvantaged communities, among female-owned enterprises or minority-owned enterprises. These gaps existed. They got worse after the Great Recession, never really recovered. Even going into the pandemic, where we had very strong macroeconomic indicators all over the place. If you looked at this area, you would have seen there was a gap, a significant number of underbanked and small businesses with very weak financial positions. So that was the gap. And then the pandemic hits. And the question becomes, what are ways we can leverage some public money with some private money to actually provide access to loans? I want to emphasize that this is different from, complementary to, different from the grants. The grants, and the state has been very generous in many grants to small businesses. Those are essentially to offset some revenue losses, some dramatic revenue losses that occurred during the pandemic, but it doesn't address the structural gap in lending to these institutions, these small businesses that existed pre-pandemic and that will exist post-pandemic unless we create these kinds of funds. Now, so I really want to emphasize that it is really this structural gap. The demand for loans by small businesses obviously coming out. Sean mentioned, some of the small businesses will never recover. Some of them will actually, they will be able to recover, but they need to make investments. They need to invest in their inventory. They need to invest in their people. They need to invest in their digital capacities. They need to invest in the reconfiguration of the way they provide their goods and services, the physical reconfiguration. So there is a growing demand for these kinds of loans by small businesses. And at the same time, as I said, going into the pandemic and coming out, we've got to worry about, well, is the supply going to be there? Is the supply going to be there? In the answer to that, we believe that public-private partnerships are going to be very, very important, and that community development financial institutions, the community-based lending, going to be very, very important. This is the way that this can get done. Community lenders are well positioned. You're going to hear from two of them today, who are well positioned to fill the large and growing credit gap, particularly in low-income communities and communities of color. They provide, by the way, not just loans, but technical assistance, capacity building of these small businesses. This is a very important combination of services. The federal government has recognized the importance of CDFIs in the distribution channel. There's an historic allocation of funding coming now through the Treasury. It will come to the state. California is going to receive the largest allocation of these dollars, nearly $900 million coming to the state through the Treasury. The focus of this is to find ways to develop these kinds of institutions, California Rebuilding Loan being one of them, to provide lending to small businesses in unbanked, underbanked communities. So it's a great, exciting opportunity. And I think probably I'm going to say that Beth and Bubble and the work with Janet and the work with what we did at the state level really was pushing, look, we have this great, here's what you can do with this federal money. And as I said, the State Infrastructure Bank also being really important. So anyway, I think now we're going to hear about and what we really, again, I'm going to do the segue here by emphasizing this is a public-private partnership. There's public money coming in at the federal level and at the state level to reduce risk. But we want to mobilize private capital to go into these kinds of funds and therefore be available for lending. So with that in mind, let me turn over to my very distinguished college that you've already heard from, Beth. And I think, Beth, you're going to handle the slides. Beth and Bobol, who have been the engineers behind this, the visionaries behind this.
Thank you, Dr. Tyson. That is overly kind, and we could not have done any of this without you and your leadership. So we're so grateful for the time and energy and passion that you have brought to this work over the last, gosh, now probably 9 months or so, maybe even longer.
Longer, I think.
Longer, 10, yeah, a year plus, yeah.
Year plus.
So thank you all, and thank you to the Bay Area Council for having us. My name is Beth Bafford. I work at an organization called Calvert Impact Capital. As Sean mentioned, we're a nonprofit investment firm, actually based out of the DC area, but have had a great pleasure of working with a broad coalition of stakeholders in the state of California to really envision, design, create, and launch the California Rebuilding Fund program. And I think what this shows you on the screen is what is so critical to this work is collaboration. I think what COVID showed all of us is that when we came together to try to solve a problem that was kind of bigger than any one organization could solve, we could actually create something much more meaningful, more scalable, and really support the whole ecosystem, and not just one individual organization or one purpose. We have an incredible group of 12 community development financial institutions, or CDFIs, who have done small business lending in these communities for decades, and really have built not only the kind of operations and financial acumen to serve these populations, but also importantly, the social capital and trust that is so critical, particularly in times of crisis. We partnered, we kind of paired that universe with this whole host of supporting partners, including, as Laura mentioned, the iBank and GoBiz, Berkeley, her organization, the chambers across the state, the Hispanic chambers, Cal Asian chambers, California Black chambers, and a whole host of other statewide and national advocates, nonprofits, and organizations really passionate about trying to address this gap. That led to the creation of this broader program. And I talk about the fund. It's not a fund kind of, it's kind of a fund in name only. It's really a set of ecosystem pieces pulled together to create, to support small businesses holistically with and through these community lenders. And so there's kind of three legs of that stool that are a part of this program. One is the capital piece, and that is structured as a loan purchase facility. So it's essentially, we raise capital centrally in a blended structure that is used to purchase loans from the CDFIs, a standardized loan product that are originated by the CDFIs to small businesses to purchase those loans to free up their capabilities and balance sheet to do a lot more lending. Two is a network of technical assistance providers and support organizations, both within the CDFIs and outside of them, to provide that high touch support. One of the things we've heard day in and day out from our partners working with small businesses is just that the amount of support needed to provide to small businesses to just navigate what are they going through? How does their business model need to shift? What do they need to be thinking about to enter new markets? How do they go online? What capital is available, both grants and low interest loans? And how do they develop a path out of this? And that is really an important role played by the organizations involved in this program. And then lastly, a centralized technology platform that makes the small business experience really easy, for lack of a term. It's really meant to have one platform that the state can market, that we can market, we can get out there, one place to go that has very clear and transparent terms, eligibility requirements, a very simple pre-application that is filled out, and then that matches them with their local community lender. That lender can then start that relationship, reach out to the small business, and help them through the process to understand whether this product is a fit for them and what other services and help that they need. And so that technology platform has really been central in creating that streamlined experience for the small business owners, as well as giving us access to real-time data to understand how the program's going, where we're serving, how we're making, ensuring that we're hitting the kind of targets that we're trying to hit in terms of who we're reaching, how we're reaching them, and how money's being dispersed. So we launched this program, as was mentioned, back at the end of last year with Governor Newsom. That was an initial $50 million facility that was really supported by a lot of council members, which is exciting. We had Wells Fargo, First Republic Bank, Bank of America, the Kapoor Center, the Grove Foundation, the County of Santa Clara, and a host of individuals who really supported that initial facility so that we could get this in the market, start to test the product, start to understand the demand, and really get a sense for how to refine and learn from the needs on the ground. That will last us through the next few weeks, and we're currently in the process of raising and closing first close of the second facility, which will allow us to have more runway and really pick up where a lot of the federal relief programs have left off or will leave off, including PPP and the grant program that Laura mentioned, really making sure that we have sufficient funds in the market ready to go when business owners kind of lift their heads up and realize that they really need access to credit going forward. The program is available for businesses that have 50 employees or fewer, up to 5 million in revenue, and really meant to serve the smallest of small businesses. I think over 90% of the businesses that we've served to date have 10 or fewer employees and are under $1 million in revenue. So this is really your small local neighborhood businesses who cannot access a bank loan, cannot typically access affordable credit. So I'm going to turn it over to Bobal to kind of take us from here and talk about the small business experience and her experience as a participating CDFI.
Thanks, Beth, and thanks for having us to do this conversation today. So just from the CDFI experience, really briefly, CDFIs, Community Development Financial Institutions, were created out of the tail end of the civil rights legislation as an acknowledgement of the market failure to reach not just historically disadvantaged populations with access to capital, but also really small, underserved, often rural communities, right? So first and foremost, I think when we think about that community, we know that the average runway for the small businesses we're serving is about 1 to 3 months, especially for our Black and Brown owned small businesses in terms of capital. So when we see then that by last June, after the first round of PPP that really didn't work through CDFIs to reach those communities, we saw in the NBER report last June that 45% of our Black-owned small businesses in California alone had gone under, 32% of Latinx owned, 26% of AAPI owned. So when we think about the California Rebuilding Fund and the CDFIs, the small businesses that we are trying to serve as small businesses to keep this capital really affordable and fair and accessible, it's through the trusted partnerships and communities we reach as CDFIs that is really trying to show up in terms of the flavor of capital that those communities need the most. And into creating more of that certainty, especially now coming out of the tail end of the PPP and grants, as Beth was mentioning, so that they can rehire and grow again. And Beth, if you don't mind going to the impact slide, what that looks like in terms of their reach of the fund so far in the last few months that we've deployed the first facility is really in making sure that the average loan size is accessible to the size of businesses that are needing this capital to be able to stabilize, but also to start rehiring as the economy opens and our main streets reopen. Seeing that the average size of business we're reaching is about 5 to 15 jobs, as Beth was mentioning earlier, and that we're really making sure the capital is getting to low and moderate income communities who have not had great access to capital before, as well as women and entrepreneurs of color who particularly have been disadvantaged and not reached well by formal financial institutions in the past. And so that we're really designing this fund to stay available, stay affordable for those kinds of businesses going forward. And one example, and I think when we think about our favorite local restaurant, our favorite local bakery, and the businesses that really hold the culture of our local communities, right, that keep that spicy sauce in our neighborhoods, as I think Mayor Libby in Oakland likes to call it. One of the businesses that was one of the earliest loans we made in December, Beth, thanks, was Alicia Villanueva of Alicia's Tamales Los Mayas in Hayward. And Alicia is not new to working with CDFIs. There's actually 5 CDFIs who've been involved in helping her first incubate her business a few years ago in South San Francisco out of La Cocina. But through the pandemic, she was able to access a fund, a loan through the California Rebuilding Fund. In the second week, we were deploying capital because she really wanted to make sure that she was hanging on to the customers and the loyalty of the customers she had built over the last few years, stabilizing the number of jobs she had. She was offering about 20 jobs before the pandemic, and being able to reinvest in her business along the lines of the pivots that she, like almost every small business owner we know, had to make to hang on to those customers and stabilize her revenue. And those are the kinds of small business owners, just to give you an example of who we're reaching, because they're the culture keepers, but also the good job creators we need in our local communities right now. So that's, I wanted to give you a flavor for the kinds of small businesses we're really reaching and need to make sure we're reaching going forward to be able to shape the kind of recovery we need to see this year.
Thank you, Bubble. And I think just to end, I think the structure of this, as Dr. Tyson mentioned, is really truly a public-private partnership in every sense of the word. The public sector recognizes that there is both real and perceived risk in serving these communities. And they recognize and understand the power and importance of small businesses in driving local economies. And for that reason, they have stepped up and provided significant funding to take that risk, leverage private capital, allow private capital to come in more confidently and at a lower cost of capital, so that we can blend those funds together and offer them in affordable rates and terms to the small business owners. And so what we're doing now in these structures is really taking those commitments from from the iBank, we have commitments from foundations interested in supporting this work, leveraging those with private capital from banks and insurance companies and corporate treasuries to ensure that we can get to the scale that's required to serve these small businesses in every corner of the state. And so certainly welcome any conversations or interest from folks interested in learning more about this structure. But we've been excited, as Dr. Tyson mentioned, we've done this program in New York and across a few other states. And we've really been thrilled by how proactive corporates and insurance companies and banks have been in supporting this work, because they see it as a really risk mitigated way to reach a community that they couldn't otherwise reach. And so excited to continue that work and that growth for this fund in California. And I'll put up our contact information here. I'll also put it in the chat in case folks want to reach out. And otherwise, Sean, I'll turn it back over to you.
Can I just mention, can I just mention one thing, which in that last slide, so I mentioned the importance of the Treasury is now going to be coming in, and that notion of the $900 million coming to the state to support these kinds of things. That is so exciting, because essentially it's the recognition at the federal level of a significant amount of funding to do exactly this kind of risk mitigation, to encourage the private sector to come in and provide and participate. And I do think that the Treasury was influenced in this regard by the fact that what had gone on in New York, what had gone on in California, to sort of show the power of these kinds of leverage of the public dollars mitigating risk and then encouraging private flow. So just, there's going to be additional big funding for this, and California stands to get a significant amount of that. So yeah.
That's terrific news, and that's a great introduction to our topic. So thanks very much, everybody, for kind of laying out the program. I'm going to ask a few questions, but I'd remind our audience, if you have questions for our speakers, please put them in the Q&A function, and we'll get to those in about 10 or 15 minutes. So these questions could actually be directed to any of you, so I may throw it toward one person or another, but obviously feel free, anybody who has a thought, just jump in on it. We might start with you, Laura, though, on sort of at a high level. Why is it so difficult for smaller business to access this kind of financial resource? Why is it so hard for them to get loans? And are there particular obstacles that impact minority and women-owned businesses that may not apply as much to other businesses, which are an important focus of this program? I think you're muted.
So there was this trend, as I mentioned in my remarks, coming out of the Great Recession. As the economy recovered, something else was going on, and that was that a lot of the traditional bank servicing or small community bank servicing of these kinds of communities was being pulled back or being reduced. It is the cost, the cost of doing transactions, these kinds of small transactions, the costs associated or the need for trust with the borrowers. It's very hard for the large traditional financial institutions, banks, to do this. It's costly to them. It's not profitable to them. They don't have the trust. They don't have the networks. They don't provide the technical assistance. So basically, the incentive for them to do this, understandably, it's not a criticism, it's just an observation. The incentive wasn't strong enough. So that's number one. Number two, these loans, and I want to hear, it turns out that over time, loans made by CDFIs have actually had a very good performance record. These are not, these are repaid. These are repaid on time. These are repaid, okay. But nonetheless, they're perceived to be risky. It's the risk of the small borrower. So I think the risk mitigation from the point of view of public funding is really important. And I would put those two things together. The private incentive for certain kinds of institutions just not really there. The public the need for risk mitigation, the public sector. And so we have an opportunity here, it seems to me, to sort of build out from both of those observations.
Great, thanks.
Beth, yeah. Mm-hmm.
So I think this might be for Bobel, but it could be for Beth too, or anybody. So how does the fund prioritize minority and women-owned businesses? Because it's open to all small businesses, but obviously women and minority businesses are a particular focus.
I can start. Beth can certainly add to the answer for the fund overall. So all of the businesses are going to one portal, right? caloanfund.org. And through that, depending on the needs they identify in terms of what capital they're looking for, where they're located, what kind of business they have, et cetera, they get matched with one of the participating CDFIs that is the best fit for them. So that can be a combination of what regions they serve, what size of businesses they serve. It's more of that matching platform. And then we really just look in terms of our underwriting. We have a standard underwriting for this fund product. We're also just looking for, are these businesses looking for working capital? Are they stabilizing jobs? Where are they in their business cycle? So it's more a matter of, yes, it's accessible for everybody. How are they using this capital? are we really meeting our mission of investing as much capital as we can into the lowest and moderate income communities? Because as an industry, that is part of our mandate at CDFIs that we're measured by on a yearly basis at Treasury. So we need to be able to meet our mission in terms of making sure our capital is first and foremost invested into low and moderate income communities and entrepreneurs who have been historically underserved and disadvantaged.
And I'll just add, and it kind of goes a little bit to the question in the chat around technical assistance and plugging into existing providers. A lot of that is outreach through trusted partners. So really finding the organizations, the technical assistance providers, the chambers, the existing networks that already have the ear of the populations that are traditionally underbanked and are trusted by them. I mean, you can't underscore the lack of trust in the system, particularly for businesses owned by women and people of color, because they have been taken advantage of by financial institutions, and online lenders and others. Not to single anybody out, but there's a lot of distrust in the system, and so being able to reach those businesses through those trusted partners and networks is critical. And that's how we're doing a lot of the outreach and education. I think we've trained over 400 business support organizations across the state on this program so that they know what it is, how to talk to businesses about it, how to help them through the application to make sure that we're reaching those who are often left behind.
Great.
Can I also just say something, Sean, just
Please.
about this, because that matching capability that Bubble talked about, or mobilizing the chambers, I just want to emphasize all of this was done by a group of volunteers. This was put together. There's an amazing matching capability we now have that I think is a real investment in the financial infrastructure of the state. And I just want to call out the fact that this was basically all a volunteer effort. If you go back to that group of all of the institutions that participated, there were people spending morning, noon, and night on getting this done. And I just want to note that for the audience and thank everyone for doing this for the state.
A true public-private partnership.
A true public-private partnership.
So on the topic of public-private partnerships, since the state of California is obviously an important partner, from a management standpoint, how does that work? How does the relationship between the state and the private partners actually function structurally?
Yeah, so the state is really a lender into the fund. So they are one of the lenders into the facility. They are taking the first loss. And so their capital is deeply subordinate, but what they are stepping up and providing that capital to support this. Otherwise, this is run by nonprofit organizations that do this work in the private sector. And so they are obviously involved in the outreach. They're in the kind of the vision of what we're doing. We do a lot of reporting back to them so that they know who we're reaching. When we need support in getting the word out to certain communities, they're very helpful there. But at the end of the day, it is a kind of privately run entity fueled by resources from the state.
Laura, please go ahead. Oh.
You're on mute.
In the creation process, for example, it's very important in the fund that we have state coverage, that it's not so individual CDFIs, oftentimes their loans are loans that are for a particular region or even a particular city. That's where their network is. This is a state fund, and so we actually have designed a governance structure, and the governance structure has allocation rules, and the allocation rules do, I think, reflect, going back to the very beginning of how we put this together, this notion that it is that the way it's governed and conversations we the state infrastructure bank at the beginning. I do want to say that there's now it runs, it is itself, and the state is, as Beth said, making a contribution to it. But the design of it took in mind that this is a state entity, not state entity, but a statewide function. Let me just put.
So this might be a question for Beth, but so does the fund have a duration? That when we started to talk, we said that some of the issues surrounding access to loans by small businesses go back a long way, particularly back to the global financial crisis. And so the pandemic is on top of that. So hopefully a year from now or 2 years from now, California is back where it was and humming. But does the fund go beyond that?
Yeah, and I think this is really a really important point, because the top line activity out of the Great Recession was positive, right? We saw a lot of economic growth, and we saw that for a period of 7-10 years. When you look at where that economic growth was concentrated, it was significantly concentrated in more prosperous communities. And many of what the Economic Innovation Group calls distressed communities or poorer communities, those actually went backwards. They lost new business establishments, they lost employment, a lot of their economic activity went backwards. And so this is really what we're, and then you pair that with some of the things that Dr. Tyson mentioned on the fact that 10 years after the Great Recession, small business lending had not recovered. And this structural changes in the financial system have moved further and further away from small businesses. And so we look at this as a source of affordable credit in the market for small businesses today. But we know that this is a decades-long challenge, if not more. And we know that if we are going to see a more equitable recovery coming out of this crisis, that we need to invest intentionally in the infrastructure and the organizations that exist to serve those communities that are often left out from those top-line economic recovery numbers, and do so in a way that is addressing these structural credit gaps. And so what does that mean in practice? This fund, the one that I mentioned that we're raising now, can buy loans for a year, for 12 months. But the exciting thing about the state small business credit initiative program that was passed in the rescue plan is that is an 8 or 9 year program. So that is over 9 years going to give money from Treasury to the state to support small business credit initiatives. And so what we're planning to doing, and we're in conversation with the state, is to essentially set up, like securitization, set up vintage years of these asset pools so that we can continue supporting the growth of these programs, continue supporting CDFIs, and importantly, that we're building a program that is stable and in the market so that a small business starting a business tomorrow knows that 2 years from now, when they need access to an affordable loan, they'll be able to get it because there is this resource, there is this ecosystem available to support them in kind of going after their own dream. And so it's a now problem, but it is also a problem that's going to last for a long time. And when we first started doing this work, we were concerned by the lack of risk capital available over time to support that. And the State Small Business Credit Initiative has really plugged that gap. So we're excited by what is to come and think that this is going to be an important part of the ecosystem for a long time going forward.
Great to hear.
Thanks, Beth. I would just add one really brief thing, is that even though the fund, the California Rebuilding Fund, may only be doing those sales for the next year or two and whatever that looks like, I think the other piece to remember is that once a small business owner finds one of us, CDFIs, the loan term, we offer the most patient capital that small business owners like these will almost ever access, right? super, super low single digits rates, like what the fund is offering, but also the rest of us, have our own sort of range of low rates. And we do 5-year term loans. So once they find us, they have a longer term relationship with access to capital and access to technical assistance beyond the fund, and potential for second checks, et cetera, out of us for continued working capital. So I think that connectedness piece is really important to remember for many years to come, to solve for some of those wealth gaps that Beth was pointing out.
Great. Actually, thinking about the long term, and this might be for you, Laura, but for anybody. So you've done a lot of work over the years on public-private partnerships, and how distinctive is this model that's been constructed for the fund? And is it a good model for other kind of financial activities that might go down a similar path? And maybe the other way of that question is, how is this different from other kind of small business loans that have historically been out there available from government or private institutions?
Turn off the mute. Let me start by saying, I think the most important feature of this is the risk mitigation to bring in private capital. That is, let's accept the notion that we're never, as Bobo said, what we have here is low interest loans. They are loans that have been, as I said, a very high performance of people paying back these loans. I don't think there's that much risk associated with them. But if I take the kind of, we want to accessibility and affordability, and therefore risk mitigation by the public dollars to bring in the private money, that to me, it's a very particular role of the public sector in bringing in private money. I mean, and I think that's a very important to this development. And I think it's recognized as important to similar developments around the country. Now, there are different kinds of public-private partnerships. I mean, the public-private partnership you've done a lot of work on this, Sean, in terms of infrastructure. That to my mind it's a different form of the partnership. It's the public money's coming in to finance some of the investment. The private money is coming in to finance the rest of the investment. There's the terms of what will the private investors secure in that relationship. So I think this is pretty distinctive in the sense of really focusing on risk and bringing, therefore, capital that might normally be, can I find a way to invest in these kinds of borrowers? Say, oh yeah, I can actually here. So that's what I would say.
Great. So 2 more questions we'll slip in before we go to the audience. One is, I think, for you, Beth and Bobo. So what do you need at this point? Are you looking for more partners? Are you looking for more investors? Or is the die set? So what do you need, if anything, at this point to move the fund forward?
Yeah, I think it's a few things. I'll talk to the kind of capital piece. Bobo, you can talk to the mentorship and advising piece. So we are continuing to bring in private lenders into the structure to help leverage the public funds. And so we certainly, if there are people interested in putting treasury dollars to work, or putting a part of their investment portfolio to work in support of small businesses, I'm certainly happy to talk more about that. And then Bobo can talk about the ecosystem and mentorship part of this.
Yeah, thanks, Beth. So one of the things we want to make sure we provide, and we do in our own CDFI, to every single client that comes in the door accessing capital, and often for pre-investment support before they're ready for our capital as well, is one-on-one mentorship. We have found that to be a game changer in both keeping actually the risk of our portfolio and the write-offs of our portfolio super low, but also to make sure that the capital they're able to access goes much further for them, especially through this past year of pivots and online and digital marketing, et cetera. So I would say the mentorship fee piece for companies or individuals who are interested in being an advisor for small business owners going through all of these challenges from financial management to marketing, et cetera. We're always sourcing employee engagement programs and other sources of mentorship support. And I can put the link in the chat if it's easy, sort of as a one-stop shop, but please feel free to reach out to either of us if you're interested in the mentorship piece as well.
I would also just go back and emphasize again what Beth said. So we need the mentorship and technical assistance are incredibly important, but we really, one of the things here is, here's the risk capital, here's the degree of leverage, here's the amount of lending we can do if we can raise the private sector contributions. I mean, it really is. And it could be, as Beth said, it could be, we have an interesting example of a regional government which has decided to take some of their treasury funds and invest in this. There are foundations that have made some investments. There are, as you saw, some of the big banks that are members of the Bay Area Council are participating through private capital. We really do have to, the size of this thing and the ability to lend is going to depend upon the contributions from the private sector leveraged off the public money.
Great. And the last question before we go to the audience might be for you, Laura, but I think this is for everybody too. So how will the fund decide success? Is it loans originated, businesses saved, jobs created, all of the above, something else?
Beth, I'd like you to let's yeah, I think we've thought through this already, but let's maybe there are some targets we should put out there.
Yeah, absolutely. I think of it as kind of measuring outputs and measuring outcomes. And we're really interested and excited that we're going to be able to do both here. So the outputs that we measure and we keep track on a quarterly basis are businesses served, loans funded, jobs created or retained, and really monitoring obviously the performance of those loans as a proxy for whether or not the business has survived. So that is kind of the outputs that we measure and we track, and we do that by demographics, by location, by zip code, by LMI status, so that we can really kind of break that down and see it across those different features. But the exciting part about this is that we also are going to look and measure and do research around the outcomes of the program. So there was a research effort that was done in Canada post-Great Recession about the importance of these kinds of public-private credit programs to support small businesses, and found empirically that there was an increase in revenues, increase in profitability, and an increase in wages for the workers of these businesses. And we want to use this opportunity to do similar research and analysis of, we have a cross-state effort. We can combine that with data from other programs across the country. We're going to have a really robust data set to see who was served, who was and who wasn't, because we're tracking who is declined for a loan and the reasons they're declined, so that we'll be able to do an analysis of both the microeconomic impact on the business, so what happened to their revenue, their profitability, their employee growth, but also the kind of macroeconomic spillover effects of supporting small businesses in local communities. Yeah. And so that's Dr. Tyson's colleague has been really critical. She was at Berkeley, is now at the Treasury Department.
At the Treasury.
She has assured me that she is not letting go of this research.
No.
So we're really excited that we'll have some academic support to really understand and look at the outcomes of these programs, so that we're smarter going into the next crisis than we were going into this.
Thanks, Beth. I would also just add really briefly, alongside the CDFI side of our house at Pacific Community Ventures, for example, because we are also mission-driven investors, we have a team that very carefully tracks the impact, the outcomes of all of our capital. So what Beth is referring to, some of us do this more so than others beyond the sort of lending, the CDFI capital pieces that we have to report on each year. But we're really looking at, are we getting capital into the communities that have had a challenge accessing capital, are we then multi-year through the 5-year kind of effect with our lending, having the kind of wealth gap outcome that we're really oriented towards? Are we creating good quality jobs? And through that, having the kind of economic spillover effect in our main streets and local communities that we are particularly designed towards. So yes, I think capturing the outcomes of the model of this, partnership, especially as it grows, will really help us differentiate. Is this yet another sort of jobless recovery for the communities we're serving? Or are we going to truly build back better or build forward better?
Build forward better. Yeah.
Terrific. On the so audience Q&A, we actually don't have any open questions because Beth and Bobo have been very effective in sort of answering questions as we've been going, so thanks. But I might share a couple of the questions with the rest of the audience too. One question was, thanks for your mentioning AAPI owned business. What is the percentage of total $900 billion fund that'll go to AAPI community, which takes over, accounts for 18% of California's population? And so the answer from Beth was, so far 21% of loans have gone to AAPI business owners, and we expect to see a similar share of funds going forward. And Bubble says, the 900 million won't come to California from Treasury for many months yet. Just to add, we hope a significant amount of it will come into this fund serving underserved communities. So that
and
was
Sean, Sean, I just wanted to put a little bit more context around that, because it also goes to the question that was asked about equity programs, investing equity into businesses. So I just wanted to be clear on the 900 million that's coming to the state of California is for a variety of programs to support small businesses and their economic recovery and growth. That will include venture capital programs, it'll include credit programs, and it'll include technical assistance programs. And so we're really excited to see what the state kind of does in pulling together a portfolio of, a portfolio of those kinds of programs to support small businesses in a range of their credit needs. Sorry. We had a COVID case at daycare.
You should mention, Beth, your family though. You do have triplets, I believe.
I do have triplets.
She was dealing with triplets during this period of time when she was on the phone morning, noon, and night putting together this thing. So awesome.
So I think that's going to be really important, and that the iBank is really doing a great job in thinking really intentionally about what are those various needs of small business owners, of startups, of existing businesses, and how do we put together a portfolio of programs that meet those needs in various parts of that cycle. The other thing I'll mention is one of the things we did learn from the initial program is that there are a lot of business owners who shut down their business and restarted a new business in a similar industry that was more COVID friendly. And those businesses a lot of times are not eligible for credit because they don't have a business history. And so what we've done is we've carved out a portion of the rebuilding fund to be accessible to those newer businesses, so that the CDFIs can underwrite and look at the kind of creditworthiness of those businesses, but so that they're not automatically disqualified from accessing credit just because the entity that they've started is new. And everybody's seeing the amount of new business starts is coming out of this, and we really wanted to make sure that there was some flexible and affordable credit available for those smaller businesses that are now starting up.
Great. We have one open question here. What is California's strategy and process for deciding how to use the new Treasury funds?
Yeah, so I know, and Dr. Tyson, you probably know this as well, but I know the iBank has been doing a lot of listening sessions.
Yes.
So iBank sits within the GoBiz office, and they have been doing a wide variety of listening sessions with different stakeholders. And I'm sure if people have ideas or thoughts or want to provide input into that process, you're more than welcome. The time frame is that the guidance from Treasury on the program has not yet come out. It's supposed to come out in hopefully the month of June. Then the states can start applying for those funds, and then the funds will start being deployed on a rolling basis after that, but it will be over a period of a few years. And so there is definitely still time to provide input into that process through the iBank.
I think the iBank, and as you mentioned, it's really also in the development of this fund and in other things. It is GoBiz, it's the Small Business Authority, I can't remember her exact name, but there's a small business office that sits within GoBiz, and GoBiz was with the Infrastructure Bank in the development of this particular fund. And I think those entities are where, if you have suggestions, recommendations, that's really the channel. It can be iBank, GoBiz, and I think GoBiz will be too small. Now we did lose, one of the people who was involved, Isabel Guzman, was the small business person, head of a California small business operation, sitting in GoBiz. She's now heads the SBA. So, that's the way the decisions will be made in California, with the governor through those organizations. Mm-hmm. Yeah.
Terrific. So we have a few minutes left, but only a few. There's no more open questions. Before we wrap it up, would any of you like to add anything to wrap up the conversation?
I guess, since I was asked at the beginning to do a macro context, let me say that this is going to end up being a very different recession and recovery. The recovery process is going to be much speedier, okay? And there's already, basically you hear about them. Are there people can't find people to work, employment has not come back, but output has come back. I only raise this because the other thing we know is that in the last recovery period and through the pandemic, what we saw was the glaring inequities and inequalities and increasing inequities and inequalities in our system. And I think in our system, and I mean in the state and in the nation, and as we're going to do the speedy macro recovery, I think, but we actually have to take measures to deal with those inequities. Otherwise, I think they probably get worse. And that's why it's really important to fit this all in as a structural change, a longer term change in the financial structures that deal with what is a long-term, pre-recession, post-recession. It doesn't matter whether the recovery is strong or the recovery is weak. Those gaps exist unless you create new institutions to address the gaps. And that's what we're talking about here.
Terrific. Unless you want to add anything, Beth or Bobo, we'll wrap it up then. I want to thank you, Laura, Bobo, and Beth for being with us today, but for your leadership of this really innovative program. We'll be excited to see it go forward and excited to see the results, which it sounds like they'll be important and very positive. So we'll be sending out an email very shortly with a recording of this and a few follow-ups for you. Thanks very much to our speakers and to everybody in the audience for participating today, and we look forward to seeing you at the next Impact webinar.
And thank you, Sean, and thank you, the Bay Area Council. Bye, everybody.
Yeah, thank you for having us.
Yes, thank you for having us.
Bye-bye. Thank you.
Bye-bye.